Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Hagren. Hey, Doug.
Merry Christmas. I just got done listening to Baby It's Cold Out There, but it's not. This is weird. We're supposed to have 51 degrees on Christmas Eve and 47 on Christmas with showers. El Nino in full effect, Kirk.
Apparently, that's only where you are, Doug, because it's 33 here, and it was real cold last night. Although it's not cold enough to start my winter pool. I'm a little disheartened. It looks like all next week's gonna be in the 40s and even 50. It'll be 54 mid next week, which is a little disheartening. And then it looks like probably I'm not going to have my between Christmas and New Year's frozen winter pool in the backyard. So a little disappointed, but hopefully it'll cheer up soon.
At
But
least, at least if you try to, it won't be like here in Minnesota, Kirk, where if they just see a little hint of glaze on the lake, they think they should walk out there and try ice fishing. And then, of course, and then finally, some of them find out very quickly that they would be better spear fishing because they'll be at the bottom with the fish. But, it happens every year.
yeah, well, we're both in the Christmas spirit here. I'm wearing my ugly Christmas. By the way, we just found these in the mall of all places. Where else would these be? It's uglychristmassweaters.com. If you want to find one, they're glorious. Great way to light money on fire. But I've got mine on. Doug's got his on, although I'm not sure if that's his Christmassy, although it is an ugly sweater. So we'll just leave it at that.
Matter of perspective, Kirk.
Yeah, it depends on who you're rooting for, I suppose. All right, well let's just dive right in. We're getting after this. I'm taking the next week off and going to be enjoying the quiet time with the family, which will be nice. But for all of you who are listening to podcasts and want to learn a little something, this is for you. So I titled this episode "I Was Wrong," and I want to use this as an opportunity to kind of talk about this. We've been talking about in the show, and I would argue only remotely wrong, but I think it's really important to be transparent when you talk about when we're on this show, right? We want to be transparent with what we've been saying. We also think it's important to be transparent with yourself, and this is really the nature of this piece, which is if you follow somebody long enough, they're going to be wrong at some point in time, and you'll probably never hear them ever admit that, right? Oh, I guarantee that like you hear, I think Byron Wien is famous for his predictions, and Art Cash and a few others. These old timers have been around forever, and they make these predictions. And if you ever, this is the time for predictions, right? And if you ever go back 12 months to see what they predicted last year, you'll find out maybe 10% of them were correct. That's just by nature, right? Probability should be 50-50. Oh, the market's going to be up, it's going to be down. Well, if you're claiming the market's going to be up, you have a 70% chance to be right over 100 years. So if you look at predictions, they tend to be incorrect. And actually, I usually do this annual thing on LinkedIn where I release a video which talks about the predictions and the nature of them. And it's always a great thing to look at. But I want to explain to the listeners here. So we've been saying for the last 2 years that Powell wants to be Volker. Apparently he doesn't. Apparently he wants to be Arthur Burns. And what that means is if you go back to the 70s, Arthur Burns was not the cause of the super high inflation, but he was one of the pieces. He didn't do anything to stop it. And Paul Volker came in and said, I'm gonna nix inflation, and he did, and he's famous for being the guy who got rid of inflation. Now, Powell wants, I thought, being that, you're not getting paid millions of dollars a year to be a Fed chairman, right? You're getting legacy as being the Fed chairman. That's why you do it, because otherwise, why the heck would you put yourself in that position? So he's got legacy that he wants, and yet he's decided to be Arthur Burns, which is, hey, we're just going to take it easy, and we're gonna lay off the high interest rates, and we're gonna, I think he said we're gonna drop like 2 to 3 times next year, which would equate to about 50 to 75 basis points from where we are. Well, you might look at that and say, well, that's nothing. And I would agree, that's nothing. But the nature of him pivoting from raising to flattening to status quo, which I think, frankly, is probably where he should be, to now he's communicating, hey, we're going to start lowering rates next year. Well, you don't usually go up and down. There's usually a trend, right? So if you start lowering, it means you're probably going to continue to lower. Now, the market has predicted for the last 6 months that, hey, they're going to lower rates. for the last 2 years, they're predicting in 6 months they're going to lower rates. So every 3 months, oh, in 6 months forward, we're going to be lowering rates. They keep saying that because the market looks 6 months ahead. But the reality is that hasn't happened. They keep raising rates. So the market's been really wrong for the last 2 years, and now they're correct. And I think what this should raise your eyebrows to is not that he's pivoted. I think that's a really important factor here. And I think the market's going to look at this and say, hey, bull market's forever. Market's just going to go straight up. Now, the problem with that is if Powell is talking about lowering rates, we have stock markets at all-time highs. We have an economy which is just barely showing signs of problems. And Powell is starting to lower rates. Either Powell is a wet paper bag or he sees something that we don't. Now, I would agree it's probably both. I don't think Powell is the strongest guy to navigate this ship. But I do think that what's going to happen here is if he's seeing some data, which Doug and I have been talking about in the show for the last 3 or 4 months, there's a lot of interesting data that we would call the green shoots, or since this is negative, maybe call them the brown shoots, although that might be a little weird. This is really signs that things are really starting to tail off in the wrong direction. Now, I don't know if that's going to happen, right? Because you see data points and it's early. You don't really know if this is going to turn into a big trend or if it's just going to be, a volatility point in the data points, right? You just don't know because it's early. We've been talking about this for a while, and I do think things that I've been hearing anecdotally are not good. And not to point out this single data point, and this is not to say Apple's a good or bad stock, but I've been in the Apple store a few times in the last few months, and I've noticed there's no one in there. Now, I can't look 2-3 years ago because I wasn't in the store 2 to 3 years ago navigating people. So this is a data point without other comparisons. So I want to make note of that. But when I was in there, I noticed, in the past, it's been full. Like I've been in the Boston store and it was always packed. I was in the Burlington store and I think I was one of 2 people in there. Now, maybe that's always the case. And I just want to be clear. It may be just an isolated example, but it's Apple. Why are the stores not packed? And so to me, it was just a bit puzzling. So it's just been one of those, isn't that interesting data point, right? It's not conclusive. It's just, that's interesting. And I've been talking to a lot of people over the last month, just, other advisors, other clients, just people in general. And I'm getting the same sense like, I'm really not doing too much. I'm staying at home. I'm not traveling as much. I'm not going to spend as much this. So I'm getting the sense anecdotally that people are spending less. They're doing less. They're like, you know what? Things are starting to get expensive. I'm just going to be quiet this holiday season. So that's another, isn't that interesting data point? Now, the data on a macro level is not conclusive yet because we're not seeing anything. It's like, oh my God, this is crazy. But we are seeing signs that are like, we should keep watching this. This is not good. Now, the market, as I've claimed on the show in the last month, if the market kind of takes off towards the end of the year, it'd be a great time to put on a short position as of, December 31st or January, because it just seems like it's a little bit stretched. But if Powell's really going to start to lower rates back down to zero, it just leads me to believe, why is he doing that? Is he trying to create the bubble, the mother of all bubbles? Maybe he is. Because I think we can all agree based on 2020, if Trump gets elected, which is very possible, he won't be elected in Colorado, which is a whole nother story and another problem in of itself. I mean, I don't care who you want or don't want as president. Even if there was the other guy who I don't like, who's running, I still want him to be on the ballot. Like, I think that's just shameful that one state would just say, no, you're not allowed on the ballot. Whatever. We can argue that point. But I think there's a lot of principle behind it that's just maybe not fair. And I think we've gotten to the point politically where things are no longer fair. It's all partisan. It's beyond partisan. And I think both sides can agree that the other side is doing it. So let's not get partisan. But anyway, let's just say if Trump gets in, I think we can all agree that he's probably going to want to lower rates and he's going to beat Powell up to lower rates because it's going to make the economy take off, which of course inflation will take off, which is good for real estate, yada, yada, yada. You can draw your own conclusions. The other guy, who knows who it is? I'm saying the other guy because it could be It could be Biden or it could be some other person they put in because Biden's not quite up to the task. So I'm just calling it the other guy. And there's no one. You could say the other girl too, but I don't think anyone's under any illusion that Kamala is not going to be the candidate. I don't think the party wants her in there. But anyway, so the other person on the Democratic side, my assumption is if it's Biden, it's the second term, he may not care as much. If it's a new person, it's their first term, they're going to care a whole lot to have a good economy. So we'll see what happens. But I think that the reality is that we're getting into a period where things are expensive. They're going to start to lower rates. Now, we have started to see people come out and say, well, hey, yeah, they're lowering rates, and that's the sign of a recession. If you look at every other recession, they've lowered rates going into recession. Now, I'm going to make a small deviation from my point of being wrong, is correlation versus causation. Now, in the past, the Fed has lowered rates because we've started to slide into a recession. That's why they've lowered rates. We're not seeing that recession coming. Now, maybe they are, but we're not in the public markets. We're not seeing the obvious signs that there's a recession. So when the Fed starts lowering rates going into recession, it's usually because the markets already realize that, the market's selling off, and so they're lowering rates into that, right? And you remember 2000s when they had a surprise rate cut and they kept rate cutting. It's because everyone knew that the bubble had popped and things were going to recession, so they started dropping rates. That is correlation, not causation. So if you're saying, well, the Fed's lowering rates, it means the market's going to go into recession. No, it doesn't. I want to be clear. It might be correlated, and it may actually happen. And we on the show, we've been predicting that somewhere in the first half of next year, we'll probably hit a recession, probably in Q2 would be my guess. But we're not seeing it now. So either Powell sees some super secret data that we're not seeing, or something else. But that is not causative. And I want to be really clear. We're seeing a lot of these charts and data points. Well, if you look at this, and we'll show you some, that this is correlated to recession. It correlated, not causative. So just be very clear you understand the difference. But I do want to go back into being wrong really quick. So what's important, we talked about why I was wrong. So I was wrong because I was assuming Powell wanted to be Volker and effectively wants to be Burns, or he's okay being Burns. So he's lowering rates. It's against what I would have thought he would have done, but that's okay, right? You can be wrong. So I want to point out this one point before I give it over to Doug. Being wrong is important. And here's the point I want to make. If you can't admit you're wrong, if you're always coming up some excuse with why you're wrong, it's because your ego won't allow it. And it means you're human, right? It means you're very much human, and everyone does this. The point isn't whether you're right or wrong. The point is being mindful of it. So if you're investing with your portfolio, whether you're a day trader or a fundamental investor, at some point you're going to be wrong. And if you can't admit when you're wrong, you're going to lose a lot of money. So if you're investing in this new tech startup and you think it's going to the moon, and at some point it doesn't, at what point do you make the decision, I was wrong, I'm going to sell, I'm going to move on? Is it when it hits zero? Is it when it goes down 20%? Is it when some fundamental factor changes? Is it when the CEO changes? Like, you have to have this baked into your thesis when you go into the trade. So if you're investing in Acme Corp, and I hope that's not an actual stock, but let's call it Acme Corp from the Roadrunner and Looney Tunes, right? So Acme Corp is a company, and you're investing in Acme, and you think that they're coming up with this thing that's going to solve for world peace, right? We're all going to have world peace now because Acme Corp came up with this widget. Okay, well, at what point do you decide that is an incorrect thesis? Is it when the stock goes down? Is it when the fundamentals change? Is it when the vision of the company changes? Is it when they stop meeting their projections? You have to come up with this thesis in advance, because when that happens, you're going to say, well, yeah, but they've got this other thing. And you're going to say, and this other thing. And you're going to always come up with some rationalization of why you are actually correct. It's just a deviation in the path. Now, there is no right answer to this. So what I'm giving you is a framework, because they could be a deviation. They might say, well, we've decided not to go into the .com. Now we're going to go into the AI bubble. And the AI bubble popped, and you're like, well, we're going to go into the weight loss bubble. Like, whatever it is, like, you see this all the time. People deviate, and it tends to change the underlying fundamentals of the company. And you have to decide, yeah, but there's other opportunity there. Yeah, or they could be scamming you. right? We see this too, right? Like, oh, yeah, we're an AI company. Yeah, but you sell cardboard boxes. Yeah, but we're AI cardboard boxes. Like, you see this happen all the time. And so you can't get into the mindset that their excuse is going to be okay, because CEOs lie all the time. They're professional liars, is what they do. Their job is to be a cheerleader for the company, and so their job is to put the company in the best light. So if that means, hey, we're doing AI even though they're a cardboard box company, that's what they're going to do. So just understand that this is going on, and in your brain you have to have a plan for when you're wrong. Now, I've said this on the show. If people haven't heard it, you've heard me say that I think this is what's going to happen, but you've also heard me say at the same time that, yes, but if they change this one thing, then I have the right to change my mind. And Powell changed that one thing, so I have a right to change my mind. I'm no longer bearish. I'm more, at the moment, agnostic. I'm open to the fact that we should probably be bullish because, hey, they're lowering rates, but it's also talk at this point, and we haven't seen any data points. Powell has just said sometime next year. Maybe we don't lower rates at all. Maybe we just stagnate for the next year, and maybe we are where we are. That's okay, right? If we're just stagnating, that's not good or bad. But my point is when they change the theme, now I'm changing the theme of the paradigm. Well, now we're no longer in a higher rates paradigm. Now we're in a, well, I don't know, we're in a Arthur Burns paradigm, which does mean you should be wary of higher inflation down the road. But my point is, it's still too early to tell, because that was just, in my opinion, just talk. Until they have a plan in place, it's just talk. So everyone's kind of baking in the fact that they're going to lower rates, and the market's probably going to go up. So you should take that into consideration as well. But I do want to point out it's important to be wrong. And I'm wrong. Doug's wrong. We're all wrong at some point in time. What's important is not whether right or wrong. What's important is that we're willing to admit it to ourselves. Not to you guys. I mean, you guys and gals listen to this show. It's important for you to realize that we're infallible. Like we're not infallible. Like we're human beings that make mistakes, and we're willing to admit it. And so hopefully this is a lesson to everybody that whether it's the stock market or whether it's your life, we all make mistakes, and the willingness to admit it is a sign of personal integrity and strength. And the more that we're able to do that, the more we're comfortable with the ability to say that we're wrong, the stronger we are within our own opinions in ourselves. And in effect, it actually makes you more confident because you're willing to do that.
This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win. Higher prices at the store, shrinkflation in your packaged goods. Higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today.
Anyway, Doug, what are your thoughts before we kind of jump into some charts here?
Well, I just saw something earlier today that short sellers lost close to $178 billion in 2023. So that goes that certainly says something about trying to make predictions and I think Michael Berry, who was famous for The Big Short, is one of those that took a significant hit. The other thing I wanted to let you know, Kirk, is that there is an Acme Corp. It's Acme United Corporation.
Oh, sorry,
ticker ACU. There's also Acme Lithium and Acme International Holdings. We're not talking about any of those.
And none of those have to do with the Roadrunner or Wile E. Coyote.
Yeah, none of those have to do at all with anything that Kirk was referring to. The other thing that I was looking at recently is rate cuts. So markets are now, according to Kobasi letter, looking at pricing in an 86% chance that rate cuts will begin in March 2024. By the way, that still means there's a 14% chance that the market that they're not, right? So they're looking now at a base case of 7 interest rate cuts in 2024. We don't know what's being thought by the Fed. We obviously, as you said, we thought, hey, you know what? He was saying very clearly and getting angry about it. Kirk, we've talked about it. Very angry that people were making predictions that he was ever going to soften on his stance of fighting inflation. Now, has inflation come down? Sure. But as we've talked about with Burns and Volker, inflation does tend to come down, but it doesn't mean it's gone, right? And if you get squirrely and you react too quickly, there is the possible chance that things could revert in the opposite direction you want them to do, and at a more extreme level. So as we're kind of looking ahead at those things, going into 2024, there's a lot of predictions. You talked about predictions and what they can mean, and how I think you said 10% of them are accurate. If we go back to 2008, most of the tremendous number of big names going into 2008 said, you know what, we predict this year is going to be great, right? As a matter of fact, I saw a list at one point where there's like 15 major analysts, and only one of them predicted anything possibly remotely negative for 2008. All but one of them were predicting double-digit returns. This one was the correct one. They were only predicting a small single-digit return. Well, as you know, 2008 turned out to be quite different than any of their predictions. So they were the closest and the least wrong of them. Who knows what's going into next year? But as you've said, we are seeing, and we'll talk a little bit more about some of the data that we're seeing that still says, look, things may not all be rosy, but depending how this gets handled, there could be that soft landing that people are talking about. I did see something else earlier today, Kirk. I was listening to some gentlemen inside the car industry, and again, these are signs of kind of what's going on and some things in the economy shifting. But they said not housing. My apologies. Auto wholesale prices have been dropping at 1% a week. Now, I didn't see how long that's been going on, but clearly, when we start seeing softening of prices, that's just because we've corrected the bullwhip that we ran into with the supply chain, or are we starting to see a reduction in the potential demand? Now, they're saying they are seeing potentially a reduction in the potential demand as people's cash flow have maybe gotten a little bit tighter, or they're waiting for better pricing that now they've identified that they couldn't afford in the old market. Now, it doesn't indicate a crash is inevitably coming, but it could if we go into a major recession, absolutely. But hopefully, again, that's another indicator or another sign in the overall inflation numbers, which just came out. I didn't look at them. I don't have the numbers in front of me, Kirk, but I think they just announced inflation came in under expectations. So, and I forget which inflation number it was that just got produced. But again, we are continuing to see that inflation number decline as they wanted it to be. Question is this cyclical, or is it secular? I said both at the same time, secular. but I mean, is this temporary, or is this a trend of things to come? 2024, and again, we've been saying this for a couple of years, so it's not, but 2024 has got a lot of question marks right now.
Yeah, and we're going to get into some of this. I think what I'm finding interesting here, and let me just see if I can bring up these charts. So there's a few things I want to point out here. So I'm seeing a lot of these, which is why I'm sharing them so we can talk about them. So the first one is the sequence of events of 2008. And so I'm bringing this up because it shows that even though things happened, if you look at 2007, some bad stuff happened. and the markets went down, then they went back up before 2008, and then they just subsequently went down over time. I just want to point this out because even though the markets are bouncing up, it doesn't mean that they're necessarily in a bullish trend. We're not at all-time highs yet. Like, even if we hit all-time highs, if you look here, this was October. I thought it was the end of the year, but anyway, it looks like it was October. We hit all-time highs even after the bad stuff happened in the summer, and the markets went down 10%. They went back up and exceeded that negative 10% by a little bit, and then they started to go down. So there's a lot of themes that go on on Wall Street. And one of them is, if you get to all-time highs, it means it's going to keep going higher, which is true in many ways, right? Is that if you hit an all-time high, it means you're in a bullish trend, right? Because obviously everyone's trying to buy. Now, there is a piece here, which is this one, which is somebody labeled it the dumb money confidence. And this is by Sentiment Trader, and it's just kind of the dumb money confidence indicator, which is close to, it's not all-time highs, but it's at the high point where you could say, all right, the dumb money thinks that things are going to go up forever. And so if you see these signs, it's usually the sign of a pullback in some way, shape, or form. It doesn't mean it's going to happen, but I do want to point it out just for this reason. Now, if you look at just a few months ago, October was a really negative sign. Everyone was bearish on Wall Street, the smart money and the dumb money. The smart money is typically the institutions. The dumb money is referred to as the individual investors. It doesn't mean that it's dumb money, but that's just how Wall Street refers to it. So you should know that that's the moniker they use. So right now, within the last 2 months, all of a sudden it's skyrocketed, whereas before it was in the toilet. Now, what's important to take away from this is that in general, it's irrelevant to look at that stuff. But at the extremes, it's important, because in the extremes, it means that everybody's on one side of the table as opposed to the other. Right now, people are trying to set up their portfolios so at the end of the year it says, hey, I owned all this stuff. So even if crypto was up a few 100% this year, or Nvidia or Apple or Meta or the Magnificent Seven, they're up a lot this year. There's probably a lot of people who are adding those to portfolios right now just so they can look like, hey, I own this at the end of the year. And then clients can feel good because they owned it. But in actuality, they didn't own it at all. They just put it in at the end of the year. This happens, they call it window dressing. It happens on Wall Street all the time, especially mutual fund managers. They do this all the time. And so, if you got a hedge fund, they have to report in the end of September what their holdings are. They'll pad the portfolio with a bunch of stuff, and then they'll sell it after because they don't want people to know what they own. There's a whole bunch of that goes on, and not everybody does it, but it happens frequently enough where you should be aware of it. Now, I want to point out, let's see, a few more things here, and then okay, here's another one. So this is the Fear and Greed Index, which is very similar. It just shows kind of where we are, where we've been. So a year ago, when the markets were down, we had a fear index of 44. Right now, we've got a greed index of, it looks like somewhere around 80, a little under 80. But something like this, I think this was put out by CNN.com. I'm not sure. I think they're the ones that hold it, but I'm not sure how they even calculate this. And this is really why I wanted to bring this up. Do I think this is wrong? No, I don't, because I think everyone's in this extreme greed phase. We went from mild fear to extreme greed in the matter of 2 weeks. So I just want to acknowledge that this is one of the quickest turnarounds I've ever seen. So I'm not saying that this is wrong, but you should always ask, when you see something like this, how's it calculated? You should always ask the question, how's it calculated? Well, it's just some fat bald guy sitting in a room by himself and making determinations not based on data. I can guarantee you there's at least one person or place out there that's doing something like that. Maybe he's not a fat guy, but my point is you've got people doing these things, and if it's not based on a calculation, you say, well, how are you calculating it? And if it is based on the calculation, you should still ask, how are you calculating it? And you can agree or disagree, right? But if you at least have the calculus, you know what it's going to be, and you say, okay, I disagree with this. It's mostly right, but it's missing this data point. So you got to keep that into account. So just something to keep in mind as you're looking at these things. Don't just take it at face value. Many times you look beneath the surface and you're like, this actually is bunk, and there's no value to this. I want to point out, let's see, one more. Okay, so this is one of those data points, and I'm going to see if there's another one. So here it is, the title: the onset of a Fed cutting cycle has been a reliable buying signal since the 80s, right? Okay, so you're putting out data points and you have no relevance for what actually happened. You're just looking at data. Well, in the past, certain things have happened. Is that going to happen in the future? I don't know. We were in a bull market for bonds for the last 40 years. We're not in one now. So does it still apply? I don't know. Why don't you have it before 1983? Show me 1968 to 1983, and then I'll see if it makes sense. So the reason I want to point this out is not that, the data points so much, but that's only part of it. Look at the chart. Why did it only go back to 83? Now, if I was a bet man, I would say I would put a lot of money on the fact that before 1983, it doesn't line up with their thesis. That's why they didn't include it.
It's a very odd number. It's not 1980. It's not a normal digit. The other thing I think is really interesting, it's a reliable buying signal. I laughed when I saw this, Kirk, because reliable buying signal since the early 80s. Well, not in the the 6 months before 998 cut, the S&P dropped 4%, or the 6 months before the 1-1 cut, it dropped 8%. That would be a pretty unreliable time to have bought into the market, wouldn't it? So
it's the reverse of anything.
their own chart is telling them maybe that wasn't as reliable as we're saying. But I just thought that was a very and this is Barclays, which has tended to have a fairly decent reputation in terms of the charting and research they do. But this is another example of you always have to question everything.
Who knows these days? It could have been from some clown in some fat guy in a room by himself who just decided to crib and put Barclays research on the chart just to make him look bad. I mean, nowadays
maybe the guy's name is Barkley.
Yes, Barkley. Yes,
that was his dog,
Mr. Barkley's research. I mean, that's the kind of world we live in. You can't trust anything these days. No. It could be fake news. As it's funny when Trump came out and said, "Oh, it's all fake news." You could argue, well, the guy was being bombastic, but he's not wrong. Like, you can't trust any data. You can't trust videos nowadays. I mean, they had that Tom Cruise deep fake of some guy who looked enough like Tom Cruise, but they had the editing capabilities to make it look like Tom Cruise, and it was famous that this was a deep fake. And it happens so often now. It's like you can't trust your own eyes anymore. And this isn't a partisan thing. This is all sides. Everyone's doing it, and so this is just kind of another lesson of, hey, this is probably from Barclays. I'm not saying it's not. To me, it seems a little odd that it's saying that the Fed rate cutting cycles are a reliable buying signal when it's actually showing the opposite. So I'm not sure that maybe they meant bonds. But yes, sure, if they're cutting rates, it is a bull cycle for bonds, because that's what happens when rates go down, is bullish. So if that's the nature of this, then why did they even bother cutting down a tree for this piece of paper? I think is obvious what would happen there. But I did want to point it out, because we all kind of look at things and we don't take a step back to look at, is this actually accurate, or is this telling me something that's even relevant? So let's see, Doug, where do you want to go next? I'll let you kind of take the mic here, and I do want to hit a few things before we wrap up.
Well, I just posted another, which was interesting when we talk about some of these buying signals and the shift to kind of where the market rally would be. It has been very interesting over the last month. The Magnificent Seven that we've been talking about has sharply reversed inside the S&P 500 in relation to the other 493 that have actually had been on a little bit of a bull run. And so we're starting to see that huge gap between the 63% gap that you're showing there. Actually, since I think we pulled this chart, there's been a significant reversal. That significant reversal, interestingly enough, I posted another chart, Kirk. It actually showed that from that equal weight index, which has, as we have shown, has been significantly lagging over the standard S&P 500, for quite some time, as those seven, those Magnificent Seven have really driven that S&P 500 performance. We saw just over a very, very short period of time that the S&P 500 equal weight index cycled from a 52-week low to a 52-week high in just 33 days. And the only time since 1957 it happened faster was September 1982, when the average stock when the average stock went on to gain 46% over the next year. I'm not going to get into any predictions or anything of what that means, but it's very interesting to see, and I don't know why, but a massive shift in kind of buying or moving money from the Magnificent Seven, or maybe it was coming from other sources, into those kind of underperforming 493, which I think, and again, we're going into this we're saying there's been this bull run. We're saying rates are going to get cut, but when you start to see kind of, peel back those layers and start to see where money's going, it does show you a little bit of a shift there in the thinking of where that money is being allocated in terms of trading in the stock market. I don't know if this is sustainable, but I thought that was a very interesting shift in where the equal weight has gone over just a very 1 month period, which is, extreme. Other than that, I was looking at something you were talking about the deep.
Doug, let me actually
address that for me. Go ahead.
I do want to address this. So I'll explain why. And this is really important. So when you look at the equal weight index, what it's telling you is that if you look at the S&P 500, I think there's 7 stocks make up 39% of the index. 7 out of 500 stocks make up 38% of the index. That's ridiculous. So the equal weight index is all 500 stocks are 1/500th of the index. Now, the importance of this is not that you should invest in one over the other, right? That's not my point of what I'm saying. What I'm saying is that if big tech, the Magnificent Seven, starts to deteriorate, then the index is going to deteriorate harshly because it's mostly made up of those 7 stocks. Now, the equal weight index, it doesn't matter. And so what this shows, and the importance of this index, is this one thing. It's great for reference because what it shows is the rally that we've had from October or November, October, actually it's October. This chart shows up a little weird. From October until today, this sharp rally, which is one of the sharpest we've seen in a long time, whether that's just 7 stocks or whether it's all stocks. If it's just 7 stocks, that's what we call a weak market, right? So if a handful of stocks are pushing the index, that is a weak market. It means that the market as a whole is not good. It just means that a handful of stocks. So if you look at those top 7, I think they're up like 75% or some crazy number. If you combine them all, 75% this year, some crazy number, right? But the rest of the market is not. The rest of the market is up maybe like 5%, or if you take the equal weight, it's up like 5% or something like that. Now that's a better indicator. Now the total return is less of an index, less of an importance. What's important here is that you see the trend, right? And the trend is we've been going sideways all year. And if you look at what's happened, well, this rally in the end of the year has been broadly based. So everything is going up together. And that is a strong sign for the economy, or the stock market, not the economy, the stock market. Which means that if this trend continues, then you should put money more into the stock market, right? Mm-hmm. And I think this time of the year, December, the Santa Claus rally, which starts today and goes until I think January 3rd or 5th, depending on who you talk to, officially that is the most bullish time of the year, and typically goes up a few percentage points in that short period. So we have to discount that. We have to assume that it's going to go up a few percentage points in the next week. It may not, but you have to assume that if that happens, then that's baked in. Now, if this continues into next year is a broad-based rally, that is bullish for the stock market. If it doesn't and it starts to bounce around again and the market's still going up, that's not a strong sign. It doesn't mean the market's going to crash. It doesn't mean it's going to go down. It just means that it's not indicating strength in the market as a whole. So what's happening here, and actually is what, I don't have a chart for this, but what's actually happening in the market is what we call rotation. Rotation is a bullish sign of the market. So for instance, let's say tech leads it. Tech, let's say in March of 2009, everything's terrible. And let's say, because I don't remember what led it out of the market. I know the crappiest stocks did the best, but let's say tech led us out of the basis of like the March of 2009, the worst period. Let's say tech led, right? Oh, actually, let's use a better example because we know this. 2020, right? At the bottom of the market in COVID, tech let us out because everyone thought, well, tech at least do well, even though no one's flying. So tech let us out. And then tech in 2021, right around March to May, it started to flatten out. and other things started to do well, right? So tech kind of went down, and so what we call rotation. So people rotated money from tech into like materials, or it went into utilities or financials, right? So there's a rotation element that, and like I said, I don't have it in front of me, so I can't tell you exactly what happened, but there's typically a rotation, and it ebbs and flows. Money goes in and out of certain sectors, and if you're invested in a sector rotation fund, this is all that they do. Is it rotates in and out of sectors based on where they are in the cycle. And if you want to be in a sector rotation fund in times like this, it might do well because it's rotating into areas that are not doing well into areas that are doing well. So it's kind of a sort of a trend following or a tactical kind of approach that allows you to put money where it's using best. Because if tech is stagnating right now, which I don't, it is kind of, but if it's stagnating, then you want to have money in things that are doing well. And that's the nature of the rotation. So the market as a whole rotates into where money's treated best. And if things are doing well, money flows there. If they're not doing well, they flow out of there. And that's what you're seeing here is money is flowing into other areas outside of tech. It doesn't mean tech's doing poorly. It just means that money's hitting other areas because all 500 of the stocks are broadly based rising. So go ahead, Doug.
No, excellent. Thanks for that. Was great explanation. The other thing I was going to say, just totally for fun, because you were talking about the deep fakes. I saw something this morning, pure anecdotal. Something like, I think they mentioned there was something like 6 people that look identical to you in this world, and there's a 9% chance that you'll run into one of them in your lifetime. Just so you know, saw that this morning as a fact. It was a very interesting statistic. I don't know, out of all the billions of people in the world, if there's 6 people that look like me, why there's a 9% chance I'm going to bump into one of them. So it's an interesting degree of separation. Totally off topic there. Otherwise, one thing I wanted to kind of talk about and address, and again, I don't know where you want to go with with this conversation, Kirk, is I kind of got into a conversation this morning, again, looking at some of the little details, the things behind the curtain. And there's a lot of people that are, inside industries that tend to be very biased with what they look at. They're, they'll kind of dispel information if it doesn't, achieve their narrative or fit their vacuum chamber. We talked. I said something earlier this week that there was a significant data point that came out that when student loan payments went into effect in October, that 40%, I'm sorry, of those student loan payments student loan payments went unpaid, that nobody paid. Now, there is some added data that goes into that detail. So that's a very bearish sign, because it means, okay, are people able to pay their bills? Now, there are some data points that go into that if missing a payment on the student loans right now will not affect credit. There's still some illegal issues with kind of getting those things paid and stuff like that. And that led to a conversation that I had with a gentleman on real estate who was talking about how the signs are all pointing to, there's some new data coming out that there's been one of the largest upticks in interest that could lead to supply in new homes going on the market. They're starting to see some real activity there. They're correlating that to a drop in interest rates and hopefully a bullish sign that there's going to be more individuals that are going to be, in the market looking for a home. The issue, again, and we've talked about this before, is that mathematically there are variables that are not just emotional and goes into purchasing homes. You have to get the financing. It has to come down to the financial capability to get the backing, unless you've got all cash. And so when we went back and forth, some of the data points that were kind of thrown out there is, yes, may not be as bearish that people were missing these student loans. And also that even though that there is a higher usage of credit card being out there, that the credit card usage right now is still lower as a component of disposable income than it was pre-COVID. And while that might be the case as well, it's not in itself directly a sign that people are they have more money so they can use more credit. One of the arguments was they're trying to go out there and use and get more and actually go back and just take advantage of getting points and stuff on credit, and more places are asking for credit, which again, this sounded to me more like a stretched argument. It's like, so you're saying that people are going out and trying to get credit card debt at a greater level in order to just, get, because they're asked to in the stores, or asked to because of these, because they're trying to get points. Well, then another chart was also produced that showed that we are starting to see the largest number of spike in defaults or late payments on credit cards. I think it just spiked to about 8%. So there's starting to be a sign there. It's like, okay, even though credit card usage may be a lower level of, or balances maybe, or payments, credit card servicing, maybe a lower amount of ratio to disposable income than it was prior to COVID. That doesn't necessarily mean that people have all that extra money in that gap available, because as we know, we've had inflation, we've had costs go up in other areas. People are paying more for almost everything. We've talked about this. Yes, it's wonderful that inflation might be dipping back, but just because inflation is down, Kirk, does that mean all the inflation that we already saw went away? No, it just means it's growing slower than it was before. And there might be some areas like we're talking about with cars that maybe now, going down in some pricing. We may see a little bit of a dip, and in certain markets, I mean, if you want to look at the real estate market, see some extremes, go look what's going on in Palm Springs. Which again, think about where people want to live. Think of a desert and ask yourself why it was, why prices shot up like they did before. Those kind of places tend to be the ones that tend to decline the fastest early on. But overall, people have had more of that disposable income eaten by the jump and uptick in inflation in so many different areas. That, and again, gas prices are finally coming back down, but for a while there, that was eating it. You've got more obligations, you've got more inflation and everything else, and food, of course, being a massive part of that. By the way, massive reversal in orange juice. That was one of the things we were talking about earlier in the year. It was one of the most, I think the highest inflation was in orange juice and coffee. It's actually, orange juice prices have plummeted. So if you're a fan of Tropicana, it might, give it a time to set back in the retail prices, but you might get some relief there, quenching the thirst. But at the end of the day, Kirk, cash flows are still tight. I don't care what people are saying. And that is something that as we go into 2024, even if these things come back down, people have less money and are starting to show, and we will find out through this retail season as a telling tale, how much of this was, taken on credit, how much overall retail numbers look as compared to projections, and is this something that's showing bearish? But we're going to come out of the season and get a real taste of what's going to potentially look like in 2024, because even if, and these might be the things that, again, Powell might be looking at this stuff. He might be looking and saying, look, I'm seeing ahead 6 months. We've got a crisis on our hand. The fastest spike in interest rates in history may, in the shortest period of time, may actually have some real lagging effect that could end up causing some real crisis, whether it's in real estate or other areas. We are starting to see an uptick in announced job losses. All of these things lead to lead to a lag in sentiment, a lag in affordability, and ultimately, as we get into next year, that's going to have some dictation on where inflation goes. It's going to have some dictation on Fed decisions, but it's also going to have some an impact. How big, we don't know, but it will have an impact on the overall economy.
Yeah, I want to hit a few things before we wrap it up. And getting into what Doug was saying, so this is actually an indicator. Some of the indicators we've been talking about in the show are not great, but they're not terrible. So they're more like the green shoots kind of philosophy. We're starting to see stuff, but it hasn't really picked up yet. This is one we should be afraid of. And this is bank credit. And it's been contracting for a while because the Fed has deliberately done that. And so when the bank credit starts to contract, and I wish I had the other chart here, which shows in relation to other things, it spiked where there's a ton of bank credit and then it started to shrink. So seeing this contracting actually is a bad sign, because what that effectively does is it pulls liquidity from the system, and when times get tough, then it pretty much causes the market to seize up. And so what the Fed will do is the Fed will go in and start printing tons of money as a way to combat that. But at the moment, they're not doing that, and they haven't been doing it for a while. I've been shocked that the system has held up as long as it has, because if you looked in March when a few banks went under, it was right around the time where credit was contracting and the money supply was contracting, and then they flooded the system with more money, and then of course everything was fine. But people should be aware of that, and I just want to kind of point this out because this is one of those indicators that, let's put it this way: there are a handful of indicators that I look at that are more like big alert kind of things. It's more like, wow, that's not good. It's not like a isn't that interesting kind of a data point. This is a holy crap data point. And this is one of those holy crap data points, right? It doesn't mean the market's going to crash tomorrow. It means like, this is not good. And if it continues, and we don't have a crisis, I don't know how that actually pans out, because that's not how the markets generally work. So I just want to point that out. I want to point out one other thing. Apparently, as of, let's see, when student loan payments resumed in October, 40% of student loan holders failed to make payments. 40%. So 88 million people, 8.8 million people out of 22 million borrowers missed student loan payments since October. And there's like 1.6 trillion of outstanding student loans. I'm not sure how that's going to pan out, but I can't imagine it's going to be very good. And I want to point out one last point here before we wrap it up. Actually, two quick things. So one of which is the 30-year mortgages, right? 30-year fixed mortgage. It's come down to where it was in the summer. So it's come off a lot. It was around 8.5%. Now it's about 6.6% approximately on the rate. I'm not sure that's going to hold up, but that we talked about the real estate market being frozen. That's going to help dethaw the market. Now it's a big swing from 2.5%. If you're getting a 2.5%, now you're getting a 6.5%. That's still a lot. So it's not going to do a ton to dethaw it. We'd have to get back to more of the 4s to dethaw the real estate market. But right now, that's it. That's a lot lower than 8. And no one's buying a home at 8. If you are, then you're probably paying all cash. So I just want to point that out, because we talk about in the show and how either the real estate market has to crash or rates have to come down. Well, rates have come down a lot. They're still much higher than they were. It's like inflation. Oh, inflation was up, but now it's down, but it's still high. This is the same thing. Yes, it was high. Now it's lower, but it's still high. So I don't know how 6.5% is going to cause the real estate market to move. I think you got to get to 4 to 5% to really start to see that to move. But it's a data point to keep track of, because if that goes down to 3%, then all bets are off for what we were talking about, the real estate market crashing. I think it should go down, but I don't think it's going to crash. I think we're going to see the mother of all bubbles, as if we're not already there at that point. So just something to keep in mind. Last point I want to make before we wrap it up is corporations. So this is something to keep track of, because bankruptcies have spiked. Actually, let me put that one up first. So bankruptcies have started to spike here, and let's see, here we go. So bankruptcies, Chapter 11 bankruptcies since November have started to spike, and you can see this here is especially since last year, it's a lot higher. Now it's still within the range where it was for the last 10 years, but it's on the high end of that range, and it spiked in the last 6 months. So that's a data point you should be mindful of. Another one is, let's see, where is it? Oh, here it is. So interest payments paid by companies. And this is the largest versus small companies. So the low line is the S&P 500. The top line is including smaller companies, the 3,000. Now, if you notice, the percentage of companies that have interest expenses greater than cash flows. Now, what does that mean? If your interest expenses are greater than cash flows, it means that you're paying more in interest than you're earning in cash. So it means your company is effectively not profitable, which can only last so long.
Federal government is one of those companies. Oh, wait, that's not one of those. That'll be another chart.
They're not on the list. They would put this off the charts if you included theirs. The federal government's the only entity that can actually do this because they can print money. But the rest of them, if Doug and I have a business and we're earning 100,000 a year and we're spending 120, we have an unprofitable business. Now, you might be able to do that for a year or two because you got some cash set aside, or maybe you can borrow money to get you through the hard times. You can't do that forever. So if you start to see companies, 24% of companies at some point this year had interest expense greater than cash flow. It means that a quarter of the companies, the top 3,000 companies, were unprofitable. That can't last forever. At some point, you're going to have a lot of bankruptcies. So I bring that up just to show that this is a forward-looking indicator that you can say, hey, this is not only interesting, but it's unsustainable. So unless things change, like rates drop significantly, or I don't really know where the other way out of there is. Unless rates drop significantly, then they're all pretty much toast. And here's a last one I wanted to kind of point out here, which is credit ratings of corporations. Now, if you look here, these are upgrades and downgrades, and the red is downgrades and the green is upgrades. Now, if you notice, there's an enormous amount of downgrades in these companies, and this is, I believe it's by S&P 500 is the credit rating. So, and they rank it by the credit rating. So AAA down to CCC. You've noticed a lot of companies have been put into B- and CCC, which is borderline bankrupt. Huge amount of companies there. And so what you want to be mindful of is that if this starts to pick up, that's a bad sign. And, the stock market could be at all-time highs, but underlying it could be companies that are going bankrupt and being downgraded and all this. It's a superficial indicator if the S&P's up and that's happening, much of like what's happened most of this year up until recently. So these are just things to watch. Watch for credit rating downgrades like this. See en masse, is this getting better or worse? Look for bankruptcy filings. Look for the interest payments versus cash flow. All those things are forward-looking indicators that will eventually hit. And so if you're not aware of them, then you'll be shocked when people say, hey, we've got a lot of bankruptcies and this company's going bankrupt. Really? Everything was great in the stock market? Well, it's not. So just something to keep in mind. Doug, you want to take us home?
Yeah, I want to add a couple little points on that. You're talking about, we're seeing bankruptcy spike up. We're seeing interest payments ahead of operating cash flows. You're seeing bank lending contract. Our economy runs off bank lending. Okay, everything. It is the access to capital for America. Okay, and
it's what creates money. Actually,
it's what creates
money.
Banks
create money, not the Fed.
Right. So we can say that we might be bullish for an uptick in purchases of homes because interest rates have come down. But if they fell from 7 and 8 back to 5, 6, that's still double what it was before. And if banks aren't lending, there's no financing to help the buyer purchase. The last one I wanted to put up there, and you have access to this, Kirk, if you want to share it. But I think it goes into, you talked about March and you talked about the bank failures. Okay, there is a chart, the reserve balance chart that was put out for the bank term BTFP. It stands for the Bank Term Funding Program. And this Bank Term Funding Program was essentially an emergency created to be able to create the liquidity to keep these bank failures going, from happening, when they started earlier this year. Now, when that came out, there was a massive spike in the use of emergency loans from the BTFP facility. This is what's basically, you have FDIC, you have the, banks are supposed to have these reserve issues. And as we know, from Silicon Valley Bank and the earlier year issues, banks had, these demands for withdrawals. They didn't have enough liquidity, and that's a bank failure. Okay. So they created the BTFP to be able to be a loan that would be an emergency loan to help these banks have the liquidity to meet these needs. Well, the biggest spike happened in March into April, right when we were starting to go through these bank failures. But it hasn't stopped. It hasn't gone up as fast. But since, and again, I don't have all of the data on the metrics of this chart indicator, but basically in March, it went from practically zero, because that's where it was created, to about 80,000. Since then, it has continued to uptick more rapidly into June, but since then, a slower increase, which looks like it then took another little spike here in December. Interestingly enough, we know banks are in trouble. We know banks that have a significant issue with unrealized losses, but we are now at basically sitting at about 124,000 on this chart. So we've gone from 80,000 to 124,000. So we've gone up another 50% since March, and they're continuing to rise in emergency loans from the Fed's BTFP. I would continue to watch that too, because that's going to tell you a lot about the health of our banking system, which again is one of the variables that goes into the contracting bank lending and all of the other things that keep the money flowing in our economy. So speaking of money flowing in our economy, Ohio State is a university. Obviously, we had student loans come back to having to be paid, and 40%, Kirk, did not pay on those student loans. If you don't know this is a problem yet, now, granted, if you told me I had a payment due and I was struggling and you're telling me that if I missed that payment, it's not going to hurt my credit and I got some time to kill, maybe I'll decide to miss. But let's face it, people in good financial health aren't going to miss that payment. They're going to pay it because they don't want the albatross hanging out there. This is a tremendous, tremendous bearish sign about the financial health of cash flow in households. And college is a massive aspect of this. And so if you think going into college, it's going to be affordable. If you think going into college, it doesn't matter, let your kid take the reins, fly you wherever, and you'll just pay the bill later, you're starting to see the impact of it. It's unaffordable to not have a plan. Get the information you need. You can go and actually get a free report. 5 questions, 5 important answers about what college will cost you. So if you have a child in high school, if they're a freshman, if they're even middle school, it's not too early to look. Go to our website, procollegeplanners.com. procollegeplanners.com. Just do the free report. Get the information to know what you can afford, because the earlier you know this, the better you can plan for it. And that plan could save you from being the statistic that we just talked about today, and is not a statistic you want to be a part of.
Yeah, thanks again, Doug. Thanks for joining us here. Merry Christmas to everyone. Happy New Year, Happy Hanukkah, and whatever else you celebrate. Happy holidays. Hopefully you spend time with family and friends and doing stuff that you don't normally get to do. So
happy Festivus. Don't forget Festivus for the rest of us.
Festivus for the rest of us, Doug.
Happy New Year.
All right.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.